welcome to our webinar series on what makes a business investable. My name is Adar Shah, and I'm an associate here at BDO East Africa. Welcome to our virtual audience and those of us who are joining in person. The topic for today is what makes a business investable, and we're going to have a presentation that covers the key success factors that make a business investable. We'll also talk about what makes or boosts investor confidence and how to build investor trust. After that, we'll mention the key themes of a successful business plan. The agenda for today is we'll have the presentation first, and then we'll go into the panel discussion. After that, we'll have Q&A and give you the chance to have your questions answered. Now, I'm really excited for this. We've got top panelists in the house, and I'm looking forward to an insightful discussion. Okay. Quick housekeeping rules for those who are joining in online. Please make use of the chat. If you've got any questions, concerns, or are having any technical difficulties, please put a message there, and a team member will attend to you. We're going to have Q&A towards the end, so please put your questions in the Q&A tab, and the questions will be answered by the panelists or by one of our team experts. Okay, that's for the housekeeping rules. In terms of the slides, we're going to share them after this webinar. It will also be recorded and uploaded onto our YouTube channel, so keep an eye out for that. And yeah, we also have feedback forms, which I'll request you to fill in. Those in person, the physical ones, and those online, the virtual one. That's it for housekeeping. I'm going to now hand over to Kunal Shikotra, who will run through a presentation. Thank you, and enjoy the webinar.
Thank you. Good afternoon, everyone. Thank you for making time to come to this webinar in person and online to our audience. It's a great pleasure being here today and presenting this interesting topic, something that's come our way by comments that we received from the previous one. And the actual topic today is what makes a business investable from an investor perspective. So the Manufacturing Africa program is a program that is actually funded by the UK government, run by the Foreign and Commonwealth Development Office. It is enabled investment and create jobs in Africa. The focus is on manufacturing and manufacturing enablers. The countries currently that are in focus are Senegal, Nigeria, Rwanda, Tanzania, Kenya, and Ethiopia. Over the last 5 years, Manufacturing Africa has assisted in over 55 businesses raise more than £2 billion of foreign direct investment. So, the fundamentals of an investable business, the 5 pillars as they call it, are broken down into key areas that every investor focuses on. The first is always the people. Who's behind the project? Are they trustworthy? Are they well known? Do they have a good reputation? Somebody we know, somebody we can rely on. The existing business, what do they do? Have they got a good track record? Have they been in business for long? Have they good credit rating? Do they support their team? Do they support the people that they work with? The market. The market is interesting. If they're looking at introducing or investing in projects, is the market the right place for them to begin? Is it the right time? Have they taken into consideration whether this product will work? Does it meet the needs of the people that require it? The project opportunity itself. Is the product that they're introducing something that's worth their time? Does it take care of the problem that they have at hand? Does it have a solution to what they're looking for? And lastly, finance. How well do they report their financial situation? Do we have emphasis and comfort in the reporting that they do? Do they take into consideration risk mitigation? Do they take into consideration the markets and the data that they're providing? Those are some of the things that are focused for investors, especially looking at businesses and organizations they're interested in. With that, there's also what boosts investor confidence. Some of the key areas, again, that boost investor confidence is leadership. Do the promoters have a strong leadership in place? Are they well known? Do they put emphasis on training? Are they happy to pass information forward? Is this something that they're looking at improving over the next 5, 7, 10-year plan? How committed are they to the project? Are they willing to put in time, effort, and help grow this business again? Are they open to corporate governance? Are they open to changes within the business environment? Are they open to solving problems? Are some of the things that keep coming up in many questions that investors keep asking. Financial comfort and discipline is key for a lot of investors. Often you find companies that are looking for fundraisers do not have proper balance sheets or financial statements. And this often becomes a problem because justification and validation is a challenge. How do you do a valuation, for instance? How do you look at potential investment coming in? How do you look at FDIs? How do you justify growth? Lastly, which is one of the most important things that we discuss this afternoon, is a clear exit strategy. Quite often, investors come into a business or into a project with the intent of an exit after several years. Is this well articulated? Is this something that is known and explained by the promoters, and are they aware of what the outcome of that will be? These are some of the questions that investors ask promoters, and this is something that we will definitely touch on during the course of this webinar. What you have on screen is the elements of an astute business plan. An investable business plan requires key areas. In the nature of time, I will not go through all of those, but the 5 points that you see on your screen are fundamental in getting what you have articulated correctly for the sake of providing and presenting information that is important for any business that is looking for fundraise. It is important to present an opportunity in the right manner, ensuring the validity of your document and ensuring that information is accurate as far as possible. Quite often, a lot of emphasis is placed on a business plan because this is the first document that everybody has witness to before proceeding and moving forward into the next phase of the cycle of fundraising. With that, I'd like to stop here, take a pause, and introduce the chairman to this afternoon's webinar event, Ed Burbidge, who will now come up on stage, please, and introduce the rest of the panelists and give a bit of an introduction about himself. Thank you.
Okay, thanks very much, Kunal, for excellent summary, and good afternoon, everybody. Nice to see you. Disappointing that the bar's not open, but I feel like it's maybe a tiny bit early. Anyway, I also feel like whoever asked the best question should probably be allowed to open the bar, so that could be an incentive for you, and I would really, really like to make it an interactive session. I gather we have already 150 people online, which is a pretty good start, and we're expecting up to 300 during the course of the event today. So a lot of them, I think, are business owners, some within the program, some from outside the program, who hopefully will become people supported by the Manufacturing Africa program. So just to introduce myself, I've been an investment banker in Africa now for 15 years. I moved out here from London in 2010 and definitely haven't looked back. on that move. I think it's a really exciting market. It's not the easiest, frankly, to raise capital for businesses, to sell businesses. Hence, there's a good opportunity for investment bankers who are prepared to take on the grueling task, but also for programs like this to support and catalyze businesses through this quite tough process, actually, of raising capital for expansion. I can see some entrepreneurs kind of nodding about that, and so it's not easy. And I think I must say I've been a part of the Manufacturing Africa program now for at least 5 years, I think, and I've been really, really impressed, and further understood the validity of a program like this to help manufacturing businesses, particularly aimed at climate improvements, employment improvement, social inclusion, to raise capital and expand their businesses. So I'm very proud, actually, to be a part of the program. In my day job, I've been an entrepreneur myself, actually. So I built up my own investment banking business from scratch, from when I moved here from London, and then I sold a strategic stake to the INM banking group, which is a tier 1 banking group here, and so we became the investment banking division, effectively, of INM. So I can relate, actually, not just as an advisor to people raising capital and getting strategic investors for their businesses, but also from a personal perspective, having actually done it and put my own money on the line and nearly run out a number of times, very nearly. So anyway, thankfully we got there and we kind of grew it to be one of the most active in East Africa. I'm also involved with a tech advisory business now called Icon, and we raise capital for climate tech businesses in particular, and social inclusion businesses across Africa. But like I say, delighted to be a strategic advisor to the MA program, and really excited by our panel today. So without further ado, I will introduce my very high-powered panel. And please give them a round of applause as I call them out and they come up. We're going to start with John Maingi from BII. You can get comfortable first. I'll ask you to introduce yourself and your firms in a minute. So the next will be Marie Nielsen from Antle. Okay, and finally, George Njaramba from Africinvest. Okay, great. So I'm going to ask each of the panelists to introduce themselves. It's much better, I think, when they do that and just talk a bit about their firms. This is a great cross-section, I think, of the investment market, from earlier stage VC type investment, DFI investment, PE investment, and hopefully I'll have some useful comments on investment banking as well. So between us, I think we cover quite a good spectrum here. And that's really is the idea of the panel. Just to remind you, the theme of this panel that we must keep to is getting businesses investable, right? So this is a panel of professionals very experienced in the market in how they view businesses when they approach their kind of firms for capital. So hopefully that's kind of a unique insight into getting your business ready for institutional capital and some of the things that they look for. So with that in mind, let me ask them to introduce themselves in the order that they came up, starting with you, John, please.
Can you hear me? Good evening, everyone. My name is John Maingi. I work with British International Investment. We are the development finance institution for the United Kingdom. We also define ourselves as an impact investor. By way of background, I'm also in investment banking for quite a number of years before I joined BII. Pleasure to be here.
Hello, everyone. Marie here. I'm a partner with Antle. Antle is a global investor. We're present in 27 ecosystems around the world. I'm here in Kenya. We also recently launched in Nigeria, which is pretty exciting. What makes us different than most other venture funds, I think, is that we work with entrepreneurs from the very early days of their founding journey. So we find people in the market looking to build, and it's really boring to build alone, and can be sometimes quite lonely, to be honest. So we bring founders together under the same roof, and then everything happens there onwards. We have a fund that can invest first check. We take a lot of risk, which is part of our model, and then we follow the company all the way. We can do everything from pre-seed till Series C between our local fund and our global more continuity fund.
Good afternoon. I'm George Njaramba. I'm part of the Africinvest investment team. Africinvest is a Pan-African investment platform. We are currently managing north of $1 billion. Some of our investments you may know, I&M Bank Group, which we bought I&M Burbidge from Ed there. Auto Express, we are the single largest shareholders. Britam, we are the single largest shareholders of Britam, Prime Bank, and Seal Africa, as well as some other small businesses. So it's a pleasure to be here and looking forward to adding value to all of you. Thank you.
Okay, great, thanks. So we'll kick off. We'll have 20 or 30 minutes or so of the set questions that I have, and then we'll leave plenty of time at the end for questions. So I'm going to call on you for questions. Are we able to take online questions as well, actually? Yeah, brilliant. So I'm going to call on you as well. So please think of like your hardest question as you've got the opportunity, because we all prefer the hard questions, really. And the more interactive, the better. So please do think of some questions as we're going along. So let's just kick off with the first one. I'm going to start with John. John, maybe a relatively broad question, but if you can just talk a bit about the core investment themes, or the key themes of investable businesses from an investor perspective, you know, in terms of financials, background in the market, the management team. What are those sort of key metrics and themes that are the first things that you want to see in businesses to make them investable?
Yeah, I think I would classify it in sort of 4 broad areas that investors generally look at. The first one is, really, can this business make money? Which means that, do you understand your revenue model? Do you understand your costs? Are you being prudent with your finances? And do you understand how your business will continue to make money? I think something that's very important to mention here as well, which has been something that has been a bit mythical, is that there's usually this propensity to want to present your business as being profitable. And sometimes, and some investors will look at loss-making businesses. As long as you have a clear path to success, when are you going to become profitable, and how are you going to become profitable? The second thing that I would talk about is there a real market for your service or product? Which means that are your customers willing and able to continue paying for you solving the problem that your business or product solves? And is this a growing market? A lot of investors look at the potential growth of your business, and that also ties to the potential growth of your customer base and how big the need you're trying to address is. The third thing I would say, which is very important, is around the team. When investors look at businesses, they always say that we invest in people first and then product later. That means that you need to have the right team. And the right team means that you have the right set of skills. And broadly, they fall into 3 categories. You need somebody who can sell, you need somebody who understands operations, and you need somebody who understands finances, how to manage your money. And there's something very interesting I was seeing earlier around a lot of businesses look at, for example, the CFO function, if you're to look at it from that perspective, and say, I want a chartered accountant. And a lot of investors want your CFO to be somebody who's not just an accountant, but somebody who is strategic. And that's a very important disconnect that we see a lot between investees and investors. I think the fourth thing that I would say is around, is your plan realistic? I think in the last presentation, there was something around the business plan and how you build it. we do see a lot of flowery language, very nice pitches, but then it means absolutely nothing if all of this is sort of leading to fantasy numbers. You need to have realistic numbers that are based off of the reality of the market you address, the reality of the opportunity you're trying to solve, and the reality of the business that you operate and its ability to continue to raise funding. That necessarily means that you need to understand where you want to take your business, as well as how much you need to take it there.
Yeah, thanks. I love those comments. If I've been asked it myself, I would say very similar things, actually, in terms of getting a business ready and growing a business. I think the reality is really key, actually, and that fundamental ability to make a profit and make shareholder returns is something that not everybody always sticks to. But then again, I think, John, you at BII, you tend to invest in businesses at a slightly later stage of the business cycle, right? I think it's maybe a good time to bring in Marie's perspective, because at the much earlier stage, often you can't possibly be making profit yet, right? And you shouldn't be, actually, or should you? I think maybe that's the question. Is for your in Antle, you're supporting earlier stage businesses as they're getting ready to bring on VC type capital, like your money in later stage VC. Mm-hmm. So are you focusing much more on the top line and the top line growth? And how do you marry that to it's got to make a profit one day, and you're taking on a whole load of institutional capital, which in many ways means it's going to take even longer to get to profit. I asked you about 4 questions in one go, but you're very intelligent. So
I'll try to unpack them,
but
it's a very good question, right? Because these guys can look at an Excel file and look at numbers and look at historic traction. We're almost trying to predict what the future is going to be like, right? And we do that by working very closely with the founder or the founding team. So we spend 8 to 10 weeks before we make an investment just working through the logic of the business. So starting from, why are you the right person to go after this business? We see in our portfolio, when we look at the more successful companies and the less successful companies, 85% of the ones in the upper bucket have very clear domain expertise in the area they're in, while the opposite, 85% in the ones that haven't succeeded, did not have that. So we sort of, tend to now become a little bit more obsessed around, does the founder know the area they're walking into? Because you're so much quicker at understanding where is that opportunity. And as a first check investor, if it takes you 1 year of learning, because it's a new area to figure that out, very few VC funds at the seed stage are willing to sort of pay for 1 year of learning. They want to pay and enter when there's a little bit of traction. And if that takes too long, there's an issue. So I think we're now over-indexing more and more on that domain expertise, playing to your strengths rather than trying to figure everything out. Especially when you take commercial capital, it's a little bit more pressure than if you're just doing it by yourself on your own, right? You can decide whatever you want to do. So I think that's number one. Also, you see a lot of things when you work together for 8 to 10 weeks, right? You can fake things in an investor meeting, look really good, really polished, everyone is rehearsed, and everything looks super nice. But when you see someone when they're sleepy, when they're tired, when they're grumpy, when they're under stress, so I think we get to see a lot around who the people behind the company really is. And if that is solid, if you can prove that you have critical thinking, so you can use the learnings you have from your customer, you can absorb feedback, you can make strategic decisions based on the input that you get, and at the same time you can convert that into execution. If you can do that, you sort of start to gain our conviction, and this is likely to be good use of our investment, which is typically $100,000 to get you off the ground. So it's almost like picturing from everything we see, does this look fundable or not? And then we know, of course, in many cases, founders are going after bold ideas, and we're not expecting every business to be successful. I also think that's important, that it's baked into the venture model that some risk will lead to high reward and some risk will not. And that's totally okay, but that means also the expectation we have from those that are successful is higher, because almost like the winners need to almost cover up for the ones that weren't successful in the logic of a fund, right? So I think that's also why you see a lot of venture focus on overly obsessing on growth, right? Like can that reach that kind of level of expectation where if you are the one to be successful, you can then mark up in a way for the ones that weren't, right? So, But yeah, I think in short, we're just a super people-centric investor,
That's
because
what
that's
you're
the only
saying,
thing you can
actually.
look at that stage, right?
And one other concept that I picked up on that you mentioned that was quite key is domain expertise.
Yes.
Can you just explain a bit more around that?
Yeah, I mean, in short, it just means you know the industry, or you know the area you're in, right? And I think we, like I said, see such a strong correlation between that and being successful. You know who to call because you have those networks. You've, I don't know, you know even what people to bring onto your team because maybe you've seen the best in that market, right? So here networks matter much more, I think, than in other markets. So if you already are in that space, you have a huge unfair advantage. And without unfair advantages, building a business can be really, really hard. So I think the importance of that clearly shines out. It's probably the strongest success predictor we have when you look at all the data, our portfolio so far. It's a small portfolio. It's 26 companies in Fund 1, 8 now in Fund 2, but still it's such a clear indicator. So if you don't know the space you're in, it's not the end of the world. you will learn, and also you can bring on that expertise into your team, right? If you're a founder, you may not be the deepest in that domain. Find a co-founder that does, and together you can sort of be quicker at both driving execution and also, yeah, I guess traction, right? Which is what the next round of investors will be asking for.
Yeah, okay. And I think it's a really, really important concept. George, do you want to pick up on that domain expertise point? And more broadly, I want to ask you a bit more about Africinvest and your approach to what an investable business is. And as you said before, Africinvest has been around for a long time in the African markets. And been
30 years, yes.
Yeah, well done. Yeah. Yeah, well done, actually. That is quite something. But so I guess you've seen quite a lot of evolution and indeed permutations in the African capital markets along the years. And so, you know, has your take on what an investable business looks like changed, and where's it at now?
Yeah, thank you so much. Indeed, I think for us, definitely, when it comes to domain expertise, you know, we require it. It's, I mean, it can be a first-time entrepreneur, yes, but you know, you need to have done it before. You need to have grown the business to a certain level because, you know, we are coming in later, you know, in the maybe second stage, third stage of the investment cycle of the business. But it's a good question, Ed. I think in my career, I've been fortunate to work in multiple markets in Africa, and when I came into the industry, you know, it was all about financials, it was all about the market, and, you know, there were a lot of transactions that were underwritten, you know, and people did well, some did not do too well, but I think over time, okay, maybe most did not do well. But I think over time, the quality of the entrepreneur has become very, very important, especially in Africa, sub-Saharan Africa especially. You don't have that much risk in North Africa when it comes to sponsor risk, but in our markets here, you really need to spend time with the entrepreneur. You know, you need to ask around. You know, we go as deep as asking the bankers, you know, to tell me about Ed. What kind of person is Ed? Does he pay his obligations in time? Because you really need to ascertain and convince yourself that you're getting into bed with the right person, even before you focus too much on the business. Because let's be honest, that also numbers can be cooked, have been cooked, right? So you can't just at this level be investing on financials. You know, markets change here and there. A good example is this year, coming into 3 weeks ago, Tanzania was doing so well. Our portfolio was up so much. Now, the last 3 weeks after the election, we are having to reconsider a lot of things for the Q4 and maybe even going into next year. So Africa is volatile, of course, and that's why we spend a lot of time with you as an entrepreneur to understand who you are, what value we can add to you. Maybe the most value I can add to you is to sort of give you advice. Let's speak in 3 years. You know, you shouldn't take offense to that. Maybe that's the time, you know, we should speak. But if it's time to speak today, I think we will definitely have to spend a lot of time together to understand who you are, you know, your business, of course, and to see how best we can add value. Yeah.
And this point that John raised actually about profit, yeah, and I think it feeds in. Sorry, this question is a bit off the cuff, so you answer it how you like. But I find it kind of fascinating, and it relates to what you were saying about, you know, unfortunately the challenges that are happening in TZ. at the moment, and a couple of years ago we had massive currency devaluation in Kenya, and Nigeria at the same time. These things happen, right? And they're going to happen. I think my point is, as an investor, how do you approach these challenges? And for a business that's looking to raise capital, maybe they're having a tough year this year, right? And the profits is either it's going to go into a loss or it's going to be down on last year, but next year it's going to go back up. How would you advise a company on that? I mean, are you going to find it impossible, basically, to take the investment forward if they're showing that? And if they're based in Tanzania at the moment, does that mean it's impossible to take it forward? Or is there kind of a longer-term view that you're maybe prepared to take that relates to the management team that you were talking about before?
Indeed, Ed. I think it's mostly the latter in terms of taking a longer-term view on the business. I mean, we invest in Africa. We know that Africa is very, it's cyclical at the end of the day. Now Tanzania may be down. Next time it may be Kenya, it may be Uganda. So for us, I mean, 1 year's performance, 2 years' performance really will not skew our decision not to invest. Maybe to John's point, it will be, okay, what's our path to profitability? How is the management going to, to turn around the business? And this speaks to the quality of the management as well, right? If you have credible management, it's a good business, they should be able to turn it around. And a good example, as you know, Ed, is our third fund, which is a COVID fund. Most of the business within that, fund were impacted heavily by COVID. And I think all of them are local currency businesses. But if you have a good team, we are very active in our portfolio. The businesses have been able to turn around. And for most of them, they are big winners for us at the moment. So we've been through that. I think we have a very good view of how to get out of some of these dips. Yeah.
Okay. And I want to go back to, I guess, to structuring businesses so that they're investor ready. Marie, maybe you can just talk a little bit about some of your experiences with some of the earlier stage companies that you've taken on, and you maybe share your own experience as well, because you've had experience yourself with the Manufacturing Africa program and how it supported a business in terms of getting investor ready. I think that would be something people would find really interesting if that's okay.
Yeah, no, getting investor ready is always interesting. I think founders sometimes tend to be so into the details of your business, right? Like you're running a day-to-day, there's so much going on. I built my own company, a paper recycling company in Ethiopia, and there are 50,000 moving pieces. And you tend to sort of be in the midst of all of this. So I think sometimes when we went through and thinking about investor readiness for my own company, it was almost like take a step back. You have to be a bit more strategic maybe, while you tend to be so focused on all your day-to-day things and you don't want them to drop. Now you have to sort of tell an investor why this is an exciting 5 to 10 year journey. How are they going to get their money back? And what kind of return expectations are they going to have? Are you passionate yourself about building a business that you're going to run for the next 20 years? Or are you going to build a business that you may want to exit in 5 years together with a PE fund, right? So all of these questions is not something I would, as a founder, think about on a day-to-day basis. I think being able to take a step back, finding a really good sounding board, I think is useful. If that's an investor you already have on board, utilize those investors to help you prepare all the necessary stuff. And if you can do it yourself, great, do it yourself, but test it enough before you go to the dream investor that you really want on your cap table, so that you're not burning the bridges too early. I learned a lot from pitching to people that I probably wasn't really ready to pitch, but that practice made me ready. So when I had the more important meetings, I had sort of gotten a little bit, the most common questions had been asked, I'd figured out how to tighten them just to get myself ready for the more important meetings. And yeah, if you have already investors on board, they also have a vested interest in you being successful in the next round, right? Or so also using your investors more. I think now I'm speaking as an investor. I think some founders run around and figure it out on their own, but we are also as an investor equally on board, right? Like we're in the same boat. If it sinks, it's terrible for my fund, and of course, so we can open a lot of doors as investors too, right? And part of my job as an investor now is to know many of the investors in town that have come, especially at the step after us, and sometimes even the step after that. And so being able to sort of do it together can sometimes be helpful. And even what we see work really, really well for early stage startups is if they open a door to an investor and they have a conversation on the sideline, if we know that conversation is going on, there's a lot of positive word of mouth we can create and help behind the scenes to get that investor a bit of FOMO maybe, so that they don't want to miss that deal. There's a lot of teamwork actually between the founder and the people around that are your close allies and people that care about you, which can either be investors or friends that you can utilize in that journey. I think if you try to navigate that on your own, it can be much more difficult.
Yeah, I think
can I add something?
Yeah, please. Yeah. Please
Maybe just to buttress the point is of really, I won't say using, but leveraging your investor. I think is very, very important because we have networks, of course. We have experience in a lot of industries, so something like even expansion is something that an investor can really help you with. We invested in a business here in Kenya. When we invested, I think we were only in Kenya and Tanzania, and just through our networks and getting sort of bolt-on acquisitions, now we're in Rwanda, and recently last year we went into Zambia. So I usually prefer it, and I love it when an entrepreneur challenges me, Ed, in terms of we need
what
this.
What do you bring? Apart from the money.
Exactly, yeah. Beyond capital, of course. We need this sort of support. We had an issue, as I think most of you know. There's been a lot of talk around the KRA on grey imports and all that. So those are discussions we also like to have, because when now we start challenging the status quo to make the business environment even much stronger, it's something that is very commendable there.
Yeah, okay. Thanks. I want to come back to a bit of that and unpack it a bit more, actually. But Maria, I want to pick up on something. There are two things that you said, actually. One's the FOMO that you have to generate in a process, I think. I mean, it's just true. It's like selling anything. You have to create that, like, you can't have it because somebody else wants it kind of thing, yeah. And also, I think you raised another really important point, which we always have as kind of a policy, that when we're kicking off, when we're supporting a company on a capital raise, you never do your first meeting with the prime investor, the one that you think is going to be, because you make all your mistakes in the first meeting, actually, right? So I think we usually do like a prep session in-house first and bring out like the scariest people in our team to ask really tough questions of the entrepreneurs, and then it feels like a piece of cake when they get to the investors. But anyway, I think those were two really important points. And George, I think what you said kind of led into my next question, which was how do you support companies that are not quite ready for your investment? And I always feel a bit conflicted asking this question, but using advisors, how does that fit in the equation? And in relation to the support that MA provides, which is effectively advisory support, what's your take on that, and helping to prepare companies that are not quite ready yet for institutional capital, but helping them get there?
I mean, for us, maybe to start with the second one, for the the leveraging advisors, BDO, manufacturing in Africa, I think it's very, very important. I think they refine the investment case. Like you rightly noted, you'll do a meeting before the meeting and prepare a company before. But beyond that, they do add value. We've seen some which perhaps, they also need to refine their own strategies, but, the use of advisors is critical. But beyond that, I don't think you should break the bank, Ed. When it comes to using advisors, we have a lot of value as well. Most of us were actually transaction advisors before we became investors on the buy side. So when it comes to putting together a business plan, I may not spend as much time as the BDO team, but I can do a good job at it. So, and we're able to add that value. I think something else that we are doing quite often now is advisory committees, just to help strengthen the governance of companies. Most of our businesses are family-owned businesses. This is their first time they're interacting with private equity. So we start a journey like 3-4 years before with an AC, sort of, just getting them comfortable with decision-making around the table so that it leaves the house, it comes to the boardroom. That's something we do. Business development is key. I mean, we're in business to generate a return, all of us, as, even for you as entrepreneurs, right? So it's good and great if we have the best boards in the world, but if we're not making any money. So BD for us is critical. So any networks that we can expose you to, you know, we are happy to always do that. Yeah, yeah. Okay,
so thankfully the Manufacturing Africa support is free of charge. So it seems like I'm just the only expensive one, actually, or reassuringly expensive, maybe. Yeah, so that's in terms of helping and structuring and get the company ready. Can you just talk briefly, and then I'll bring John back in, but about the end game? Yeah, and I don't want to spend too long on this because it's like a whole different subject, actually, investment returns and exits. And by the way, this is a series of events, so I think we'll come on to that in another event. But it is important, I think, because for institutional investors, certainly in my experience anyway, when you're coming in, particularly PE, VC funds, you have to be thinking about the end game, right? You have to be thinking about what the exit is, what returns you're able to generate. And can you just talk about how you think about that and how, like, a business owner can get their head around that mindset of, you know, how that's going to happen and how you'll do it together?
Indeed. I mean, for us, we pursue joint exits, meaning that you know, we are exiting alongside the entrepreneur effectively. And I think we all have to remember that most of our capital, I think for myself at least, it's termed capital. So we raise a fund, it's a 10-year fund. Within 10 years, it has to be liquidated. Of course, now there is the prominence of evergreen funds, and we have one within Africinvest, which they are not in as much pressure to exit, but in 10 years, you know, I have to liquidate my investment. So when I'm coming in, I have to think of, you know, sort of my way out. And we mostly do joint exits where we align maybe in 5 years, you know, we achieved our business plan, we've achieved the strategy. Let's tease the market. Let's come to advisors, let them tell us, you know, could there be potential buyers? So that's a discussion we have very early on with entrepreneurs so that it's clear that most importantly, we have a termed fund. And then number two, if you want to realize some value for yourself, you can always accompany us as we look to exit. But we will never exit where it doesn't make sense for the entrepreneur. It always has to make sense for both of us, yeah.
Okay. And by the way, this is the last round of formal questions before we bring you in. So please start getting your questions, they're really thorny ones, ready for us. Yeah, so let's just finish off just talking about returns and expectations, and maybe my friend can just tell me how we're doing on time as well. Can you talk a little bit about returns, Marie, and your expectations? And basically, you know, like we were talking about in the prep session earlier, you know, you have underlying investors yourself, right?
Yes.
And I guess, you know, you're able to take quite a lot more risk, but at the same time, you've got to make good returns. And so
Yes.
how do you manage that sort of uber challenge and come out with those returns on a portfolio basis? And how does that relate to companies approaching you for finance?
Yeah, as much as we are trying to understand the entrepreneur, I also think it's super healthy for the entrepreneur to understand the investor. And there are different kinds of investors even here, right? So what is success for that investor, and does that align with what you see as success? I think that's really, really important. As a fund, like you said, yes, we have raised the money from somewhere. It's not my private money. I wish it was, but it's not. So I'm in a way liable for making a return to those people that believed in, you know, us as a fund team to use that money wisely, right? So given we're answerable to them, we need to have some kind of, our expectation is sort of their expectation to some extent. And I think very standard in venture, it's to try to return 3 times the money that you have taken. It's quite, I mean, some funds will aim for more, some will aim for less, depending on their model. But if you think about that, if I invest $100,000 in a company, it's not enough to just get 3 times that back from that investment, right? Because there will be many companies that don't make it. So if you assume that in venture, I mean, 80% could fail. That means that the 20% that succeed need to pay 3 times back, plus 3 times all of the other ones that sort of collapse on the way, right? So that's where it gets really, really hard. And we have now started actually changing a bit our investment model. So this is very classic venture, what I just described. We still do that, aiming for hockey stick growth companies. Honeycoin, I don't know how many you saw, they just raised $5 million with a typical venture business model, but there are not too many of them there, right? There are many other things that can make money that aren't typical venture. I don't know how many of you have seen Uncover, the skincare brand, for example, doing remarkably well. So I think we've now started shifting towards, okay, there's a part of our fund that will remain going after those, investments that could give you 100 times back, but we are also now starting to branch into the more tech-enabled, even sometimes real economy space, where we need to then believe risk is slightly lower. So if you make 10 investments, 8 will not fail, but you make 10 investments and maybe 6 will fail, or 5 will fail, or 4 will fail. The lower the better, right? But that means also the return expectations on those that succeed, you have more investments than that can help repay. So that also lowers the bar a little bit for what that end state needs to look like in terms of size, profitability. It opens up for more freedom to invest a bit more into something that fits this market a little bit better, or fits more entrepreneurs better, because not everybody wants to build a venture company. Like, I'm actually an entrepreneur a bit on the side. I'm building a camp for runners in the 10. No venture fund should ever put money in that. And I think a lot of entrepreneurs want to build nice businesses that can do really well. So success for an investor and success for an entrepreneur can be so different. So I think making sure those somehow align, and then also as an investor, we adjust our approach to different kinds of business models, I think is super healthy for this ecosystem, because there was a time everybody had to be a tech company. Even though you were not a tech company, you would still put some tech in there, which made no sense, but that was pretty much the only early stage capital available. I think it's starting to become a little bit more, a little bit more wider than that, but still, it's not easy to raise if you're, at least from the venture funds, unless you sort of fit that ticket, so yeah.
Do you expect your investees to have that mentality of what returns our shareholders, including ourselves, going to make out of the business? And maybe I'll flip that and ask people in the audience, actually, first of all, how many people here are business owners? Okay, excellent. And so, for you, do you think about your exit end game and what you expect your return on equity to be, and do you even kind of manifest that? Some people look at the final check they're going to receive for the $500 million or whatever it is. To what extent does it enter into your sort of daily thinking what this business is going to be worth and how we're going to get there? I didn't prep any of you for that, so you can just say no, and I'll hand it back to Marie to answer. But if anyone wants to, please, will anyone jump in on that? Yes, good man.
So I think for me, I'm a bit of a special case because I'm a transaction advisor myself, so yes. But I'll tell you for sure, a lot of businesses won't be thinking about that as they approach an investor. They just need money to get to the next step. So, you're thinking, I have payroll to meet, I have, raw materials to bring in, I have to meet the next batch. Can I just get an investor to get me something to move me to the next level? And I think that's where a lot of people make mistakes, because down the road you realize that maybe this investor wasn't the right fit, because what they were looking for down the road was very different from what I'm looking for.
Yeah, that's a good point. Yeah, thanks. That's a really excellent point. Do you want to pick up on that? I promise you I'll ask you a question again.
I mean, we are starting more and more to have the discussions with the entrepreneurs at the, before the company is incorporated, we speak about what's success for them. Because it's also nice to know if someone just wants to build a lifestyle business, then probably taking venture funding, whether we're tech or tech enabled or not, is probably not the right thing to do. So sometimes it may happen we walk away from a deal because we realize this is not going to be the right sort of partnership, right? So I think it's important to think about it. I also think sometimes it can be a bit of a motivation, because running a business like ups and downs, for me, oh my God, when there were lows, I loved having the idea of, okay, it's only 2 more years and then we're going to sell it to somebody, right? Like, so sometimes also it can be nice to have a goalpost where is this going to, what's success and what does it take you to get there? And that is different for different people. But for me, having some kind of idea was actually a motivation factor as well. If I get there, or it can be okay, you have different milestones along the way. The first one is profitability. Once you get there, then I know, okay, to raise my PE, I need to get sort of this amount of non-profit because the multiple is going to be this. So you backward a little bit. And for me, that was motivational, but I guess that differs from different people, right?
I felt like you wanted to jump in, did you? Are you sure? Later, definitely. I can tell that you'll have something brewing, actually. Okay, John. Sorry, you've had a lot of time to think. So can we bring it back to DFI investment? And can you just talk a bit about our friend, you didn't say which firm you're from. You're from BDO? Yeah, I think you should have said that because you made such a good comment, actually. So nice. Yeah, he made the point that you should be thinking about what's the right type of capital and the right kind of partner for you. Can you talk about where a DFI comes into that and in which case a DFI is the right partner for a business?
Yeah, absolutely. So from a DFI perspective, we tend to look at more mature businesses that have been in the market, have a sort of proven track record, but also equally as important, there's two things that matter, especially for BAI, which, as I said before, we also define ourselves as an impact investor, which is one, the commercial acumen in terms of the things I mentioned before. You have a feasible business model, you're making money, you have a good team, and your business will continue making money because the problem you're solving will continue to exist and is in such a large scale that there's prospects for growth. On the other hand, there's the impact part of things, which for us is equally as important. We look at three things. We look at economic inclusion, which is how many jobs are you creating? Are women getting empowered? Are people getting uplifted from poverty due to the service or the product you're offering? A very good example of that is, and I like to give examples on these kind of things because they're usually a bit esoteric and in the air for a lot of people. The economic inclusion part is when you think about businesses like, for example, M-Pesa in Kenya. M-Pesa came in to solve a problem of a very large unbanked population. The banks were not willing to go to the last mile, and the people at the last mile wanted financial services that are not just table banking or putting money under the mattress. So they've had incredible commercial success, as well as very high impact in terms of even day-to-day workings of how Kenyans work in terms of sending money to your upcountry home. Somebody somewhere is getting something to pay for their children's school fees. You think about it from that perspective, that's economic inclusion. The second bit is about climate environment. This is a very esoteric and topical area. A lot of people talk about climate. They talk about mitigation. They talk about we have planted 1 million trees. But we look at it from what is the true impact of the work that you're doing in terms of how that positively affects the environment, in terms of is it reversing environmental degradation or is it adding positivity to climate resilience, either at whatever scale that you're operating it. The third bit is around financial inclusion. Financial inclusion means basically that people who would otherwise never have gotten access to financial services are getting access to it. Those three things are not always looked at in equal measures. It really depends on the business that you are in. However, for BAI specifically, impact for us is not just big numbers you publish in your annual reports or saying that you've empowered communities. What does empowering communities mean, right? That's a very PowerPoint pitchy kind of way of saying things. We want to see that your business model actually incorporates these impact metrics in the way you operate. That this is not coincidental that you have helped somebody, but it's something you thought about as you're doing your business and you're doing your business responsibly. So from a DFI perspective, we look at those two things. When you talk about development, it's usually more around the impact metrics that I've mentioned. And then the commercial bit of it is also equally as important.
Okay, we're just going to do a quick time check. How are we getting on? Yep, we can move to questions? Yep. Yeah, okay, internal, and then we'll move over, yeah. Okay, so I guess the follow-on question for me was, as a DFI, you'll be is it fair to call it a more patient investor? As in, you have less of a fixed time frame. So this is maybe a bit of a naughty question, actually, but so does that mean your entrepreneurs are less ambitious than than the ones that the VC funds or the PE funds are investing in, because they don't want to get to the 500 million in 5 years, they're okay to do it in 9?
That's a very interesting question. And I think there's a very big misconception around two things with DFIs, that we are cheap money and we are willing to wait for 50 years to get our money back. Unfortunately, the reality of how that works might be slightly different. As I said, the commercial bit of things is as important. We do have return requirements. I think, like George mentioned, we also have a shareholder who expects a return. But I think the only difference is that we are more understanding investor. We're able to walk the journey with you in terms of, as long as you're meeting these impact metrics and your business will continue to meet that, and you have a commercially viable business, if you need some breathing room, then probably a DFI is somewhere to look at. However, I will say that DFIs tend to be very notorious in terms of we don't look at early stage businesses. So usually it's more mature businesses that have been there for a while that just need a bit more patient capital to get across the line.
Yeah, please, yeah.
Maybe for the interest of the, I mean, you know, John is my shareholder, yeah? Just to be clear, yeah?
You've disclosed your conflict.
And I was also going to say, getting money from a DFI is probably the hardest money. So I think if you're a lazy entrepreneur, you don't go to the DFIs. We also have DFIs in our fund, right? And the process you go through is quite educational and also quite thorough, I must say. And yeah, so you need to be a solid entrepreneur to be able to manage that.
Yeah, no, exactly. Yeah, no, I was only kidding. But I wanted to see what your answer was. I actually think it leads on to another interesting question. I don't want to make it too technical because obviously it's designed for business owners, but I think it's still relatable point is it is relatable because they need to be aware of what kind of capital they're taking on and your time frames, right? Is the DFI approach of being a bit more patient more applicable to this market and the challenges that we come across that we were talking about earlier? How do you, George and Marie, how do you tackle that? Because in my view, frankly, as a business owner and an advisor, like a 5-year time frame is quite tight, actually. To get into a business, to invest, to execute a growth strategy, to exit and achieve your 25% IRR or whatever it is. That's a tight challenge, I think. And so, do you wish that you worked for a DFI and that you had that their approach? And more seriously, how do you handle that model, and how do you get your entrepreneurs, your promoters aligned with it?
I mean, fortunate enough, previously I was working for a DFI, so but indeed, I fully agree. I think the private equity model in Africa, perhaps especially for SMEs, needs a little bit of thinking and retweak. A termed fund, it has worked maybe by and large, but it could be better. I think there's need for more patient capital led, as you rightly noted. Again, this is a smaller business that is being impacted by the same macros, the same cyclicalities. Its performance will not be the same as a bigger business that has maybe better financials, has better access to capital, etc., etc. So, I mean, for us as Africinvest, our SME fund is a longer-term vehicle as opposed to our traditional vehicles for the larger businesses, just to account for the fact that we are cognizant of the fact that business plan implementation may take longer. The exit may even take much longer if indeed it happens, and there's need to work with the entrepreneur a little bit more intimately. So hopefully we see more of permanent capital vehicles, especially for the SME ecosystem in Africa. Yeah.
Yeah, you can all please feel free. Yeah.
Can I just add a little bit to what George has said? I think one of the important things to note, especially with DFIs, is that we are not capital for everyone. I will give you a very good example where we recently worked and closed on a transaction for a solar home system company, one of the biggest ones around. That company, we had funded them before, and the reason we had funded them before, sort of at a more senior level, was because commercial banks were not willing to look at that sort of investment. Their pool of investors that they could access was quite limited at the time, and so there was a need for DFI money to come in to help them grow to the point where in this last round, more than 70% of the funds actually came from commercial funders. And so that's kind of how we look at our role in the ecosystem of funding. We're not necessarily a choice standing side by side with commercial funding. We are a choice that is for a very specific type of investment.
I think that's an excellent point, actually. Well made. Did you want to add?
Yeah, on this timeline thing, I think we made some adjustments in our second fund. Like we invested for 5 years in the first one, which only leaves 5 years to exit, which is little. So we made the next fund 3-year investment period, 7-year. And even on top of that, fund 1 had 1 + 1 year, so you can add 2. We added now 2 + 2, so we have added 4. So technically it gives us 11 years from the point we make the last investment till we need to return. So we've baked in, I think he's almost as patient as a DFI. But also I don't want to die at my desk, right, running this fund. So there needs to be an end to all good things, right? So,
That's true.
yeah.
That's true. That's true. There are a lot of arguments around that on all sides, and that's probably a conversation for another day, I suspect. But I think you've made some of the really key ones, so thanks for that. Right, it's your turn. I know that you've been waiting, you're dying to ask your big questions. And so I'm going to ask you to put your hands up, whoever wants to ask the first question. In the meantime, can we be managing the online questions? Can anyone just give me an idea how many we have, for example? Yeah. In the meantime, please kick off with yours. Do you want the microphone?
Thank you very much.
Will you introduce yourself first, if you don't mind? Yeah.
Sure. I'm Ron Sarkar. It's my first week at Manufacturing Africa. We're doing a great job. Just wanted to ask kind of a general question, but you could speak to it from the context of Africa and manufacturing. The art or science of projections, right? And how you think about that as an investor and what you see coming from entrepreneurs, right? I've always been intrigued by how projections are made specifically into a much longer term out, and what the thinking goes into that, and how you buy that.
Good question. Does anyone want to take it, or should I allocate it?
I'm happy to go first. I think, like I said earlier, one of the most interesting things that we experience as investors is seeing this fantasy projections. So you look at the fundamentals of the business, the story you're giving when you put together your business plan, and your numbers are not matching up. I feel there's a very real need to be very honest around the prospects for your business, where your business lies in terms of the ecosystem that you operate in, the competition you have, your suppliers, your possible customers. Those should be the key drivers that actually drive your projections, including your internal sort of operating structure. A lot of times we see a very high mismatch between the story you're telling and the numbers you're showing, which usually it may sound funny, but the problem is that it's very horrible for building trust with your investor. Because if you're showing me a number that doesn't make sense, that is the first impression that I have of you.
Yeah, we are just going to add quickly, we had a conversation on this week with a client of ours and an investor who's about to invest, and they said, I won't mention the names, but it was fascinating because they got right to the crux of this. They said, look, like, thanks for your projections, and they look amazing, but they look a bit too amazing. But we love the business and we know you're going to do really well. Just, this is your last chance. Put together a set of really reasonable, achievable projections, because after this, we're going to hold you to that for the 5 years. It's not like we're going to bury it and never come back to it. And if you fall short of it by like 50, 60%, it's going to be very hard for us to put more money into this business. Yep. If you fall short of it like 10, 20%, that's probably okay, right? Because of external factors. But also, don't make it so awful that we can't invest because it's falling off a cliff tomorrow. So in a way that sounds really complicated, but actually if you think about it, it's exactly right. You've got to pitch it there. It's got to be honest but aspirational, basically, and something that that everyone's happy to be held to. That was my experience. Good question. Yes. Can someone bring a microphone? Is that possible?
Thank you. My name is Mary Wamai. I'm a retired commercial banker. So one of my questions is, are the investors generally pessimistic? Because you give them very good numbers and they're asking, are these really good? Are they true? But on a serious note, when does the governance structure become a thing? Because we have stage 1, stage 2, stage 3 mature. At what point should the investee or the business start thinking about that? Because even in commercial banking, it becomes an issue, especially with owner-managed businesses and family businesses. At what point we bringing a new shareholder and set up a management team, independence, and things like that? When does that become a big thing for you guys?
Okay, that's a good question about governance and structures. Actually, that's a really, thanks a lot for bringing that up because that's increasingly important, I think. Does anyone want to kick off on that?
I mean, since we start from the earliest stages, we see sometimes when too much governance is put in place too early, that can also be really, it's a very tricky one. So sometimes we see seed investors that want to have a very formal board, they want board seat, they want control, they want, and I think that's really, in our opinion, we don't even take a board seat. We're happy to have a board observer seat when eventually a board is formed. But I think in the early stages, like leading up to probably closer to a late seed round, the founder should have the freedom to experiment, to do quick iterations without having to drag along a board that sometimes don't even understand the customer. So we fight a lot sometimes when later stage investors come in and they want too much control. I think that's a bit risky. And then, of course, when is that right handover point where you do need proper board structure, you need proper governance? I think late seed till Series A is where it starts, where the investments become so large that investors would want more visibility. But before that, I think it can almost destroy a company and the freedom the founder has to prove that there's even a business opportunity there.
Okay. Yeah, it's a really good question. Yeah, really good question. Thanks. So, I mean, we could talk a lot more about that. Somebody else might ask a question on that as well, and we'll talk a bit more. Should we take one of the online questions, just so they don't feel left out? Sajan, do you want to represent the online community?
Yep. Yes, it is. There are quite a few, actually. But I think I'll start with a few that are related to the same topic. There have been quite a few questions relating to manufacturing startups or startups coming within the manufacturing space and also potential greenfields. And I know we have a few greenfield players in the room here. But how can they access funding that they require to start their businesses and scale it up? And what are the timelines or timescales that you would be looking at, and how would we address approaching potential funders in that space?
Okay, that's a few questions that you're kind of putting together, basically, is it? Yeah. Okay, great. Does anyone want to kick off on that?
I can take it, at least start. I mean, greenfields have never been in the purview of private equity, by and large. But I mean, we have an envelope for that, for instance, because we do recognize that, and especially in the manufacturing sector, there are still opportunities that can be explored. But when it comes to greenfield of importance, and it was rightly noted before, the sponsor becomes very, very important because this could be somebody maybe who has worked in the same field and, he's just venturing out on their own to begin, this greenfield project. We are seeing one here, there's one in Rwanda as well, very credible sponsor. And in that case, the project becomes, the business becomes relatively de-risked, right? And you can make a case for it. But that being said, it's something that we are seeing more of at the moment, really, especially in the East African ecosystem. And we may do one or two where we believe that we understand the risks a little bit better, yeah.
Yeah, I think so. I don't mind jumping in, I guess, having been an advisor to businesses here for a long time and on behalf of the program as well. I think greenfield is challenging, frankly, to raise in our capital markets here. I think, the more that you can achieve and de-risk your model on your own balance sheet, the better, frankly. And the easier it is to get to approach institutional capital, which is what my panelists represent here, and even to access bank capital as well. It is challenging, the greenfield financing for manufacturing. I think there are angel investors around. But I do, and for us at MA as well, when we're looking at something and trying to kind of judge whether it's worthy of the subsidized support, we need to have seen progress with the business and a number of tangible business model hurdles achieved, really. We're always keen to help businesses, particularly ones that align with our key theses. In terms of achieving social good and climate good and developing the economy, we're always keen to help. But I think the more that can have been achieved in terms of key business milestones, yourself before you raise capital, the better, frankly. Yep. Should we take one more online, or should we come back to real world? Yeah, it's okay, is it? Okay, we had another question, I think, over at the back here. Yeah. Well, oh, brilliant. Okay, we've got quite a few, actually. A gentleman in the fourth row here in the T-shirt. Yeah. Is my maths okay? Fifth row?
Very much.
Please do introduce yourself, if you don't mind, first.
Yes, yes, hi. Hi, everyone. I'm Fabio. I'm the founder of a startup called 10x Nutrition. We actually make nutritious mandazi. And we built a modern brand to commercialize this to tackle malnutrition in Kenya. And my question is a bit related to the one previously asked, and one that is probably relevant to a lot of manufacturing startups where CapEx plays a big role. And it does for us. And we've been in the market for a year and a bit. Traction is wonderful. Selling a lot of products and product market fit. Everybody says, yeah, it's fantastic, but next step requires a lot of CapEx. And I think a lot of startups see that, right? That their product is selling, their service is selling, but for the next step, they need, 6-7 digits for CapEx. But most of us say, sorry, your budget currently is too small, doesn't really legitimize tickets of that size, especially when it's CapEx. How can we overcome this?
I'm just thinking about my own business as well, right? Which also had some machinery and other stuff. But I think the first one is, can you break it up into pieces? So instead of buying that humongous, nice German machine, like we looked at cheap stuff from China in the beginning, and once the cheap stuff from China didn't work anymore, we could now upgrade ourselves to something slightly, an Indian machine, So there was like this ladder we had to climb. So if you can sort of break it up a little bit, because there's also a little bit delusional thinking on nothing, you can just get like, I don't know much money it is, but so if there is a way to stagger it, I think that would be, that's what we did. It wasn't great, it wasn't pretty, it wasn't the nicest. We had the Minister of Norway come and look at the site. I was like, oh my God, I hope. But still, it's okay, it worked, right? So I think that's one. I think the second is, can you make, this I didn't even know, this someone, one of my good investors taught me, the difference between a bankable greenfield and unbankable greenfield. What made something bankable, in his opinion, was, for example, when we were looking to expand into refuse-derived fuel at the sorting station. We wanted to build a large sorting facility at the landfill in Addis Ababa. That was not easy, and that's a huge undertaking, and where I was going around delusionally pitching millions of dollars that a tiny little company was going to expand into. It became bankable for him when I had one of the big cement factories as a secured off-taker, and they were willing to put a bit of money in the project with me. So that's when it's okay, now it's bankable. Before it was not bankable. So is there something you can do that makes it a little bit more than just you running around with an idea and a little bit of revenues that can maybe also help you gain that sort of investor conviction that it's not, selling thin air or something?
Yeah, it's amazing how quickly a new business how quickly the glamour disappears. Actually, right? And suddenly, everything's got to be the cheapest you can possibly do to achieve what you need to achieve. Yeah, the fun disappears quite quickly, I think, in building a business, frankly. It gets very gritty, and then maybe if you make it through, then the glamour can come later. So I think that's a good question, and does that answer it?
Very much, yeah. Thanks.
Yep. Okay, brilliant. Should we just take one more from here, and then we're going to go back online? Yes. Yep. Just here, if you don't mind, for the microphone.
Hi. Okay. My name is Stephen Gadai. I run a company that does risk management, more from the family business perspective. The question that I have, especially to John, who said he's more on the impact side of it. Maybe what are you doing to get access to business owners who are in the informal sector? Because most of the time you find majority of businesses, especially even in Kenya and in Africa, 80% of them are informal, and they are not even aware that these kind of funds are available. They've not put their systems in a good shape, not that they were not intending to do so, but they are not even aware that they need to do that. I've audited a lot of these informal businesses, and you find they have great potential, but they are not aware. And now, because you're also in the business and you want to grow, how are you tapping into this market, which constitutes even over 80% of employee base?
Yeah, I'm happy to take that. I may not be the most experienced, appropriate person to answer it, but I think from what I have seen, yes, rightly so, a lot of businesses are sort of in the informal sector. However, I have seen some situations where, and it speaks to something very important that I think a lot of businesses need to understand. There are some funders who, for example, will have technical assistance facilities that can help you move from the point where you're super informal to the point where you're formal and able to grow, right? And there are also other investors, for example, private equity or venture capitalists who would also walk the journey along with you, right? The investment includes provision of personnel, provision of the networks they have, provision of the structure that you need, and provision of the exact formula you need to get to the next phase of things. So I think from my perspective, unfortunately for DFIs, we tend to be a little bit more stiff when it comes to sort of looking at the informal sector. However, there are instances where we look at that, and we have had examples where we've really helped businesses that are nascent, that are solving a problem that is big and scalable to get to the point where they can be able to achieve scale.
Okay, thanks for that. It's because maybe, even though my eyes may be serving me long, even the room could not be representative of all cadres of business owners.
Yeah.
Not judging by how we are, but you find...
Thanks for the clarification. Yeah, you feel a bit better now.
I think because I'm an auditor, so I've audited the room, and my eyes are telling me we could be more from the formal sector.
Okay, we'll receive your report later. Brilliant, thanks. I think let's let this gentleman go, because you thought you were off, and then it got handed to someone else. So please go ahead if you can introduce yourself first.
Thank you. I'm Fred from Lake Victoria Tug and Barge. So very happy to have the karaoke mic for a change. But my question really is, how do you manage the difference in expectations of when a business is investor ready, from the entrepreneur's side and from the investor's side? And then, once you've started evaluating a business, and you say, man, this is something that really is worth spending time looking at, and then you find problems, what do you do? How do you go about it, and how do you address those two gaps and cover those?
That's a good question. George, you want to pick up?
So, I mean, on the entrepreneur side, on the investor side, right? I mean, we are notorious for taking our time, right, as investors. But yeah, I think most funds here also for John BI, you know, they sort of have sort of list of sectors. That's number one, that we use to sort of do a quick screen of the opportunity. I mean, for private equity, definitely being an operating business helps greatly. I think being greenfield or close to, maybe you've started, that may take a little bit of some time to get through the system, being fully transparent. But an operating business, even with challenges, etc., that will be easier because there's a system in place. There's already, if it's a manufacturing sort of enterprise, there's a factory in place. And to the point of the gentleman, maybe, I don't know what stages the businesses here are at, but as early as possible, if you can put certain processes in place, it will be very important. Accounts, for instance, you don't have to do very big things, internal audit, governance boards, but some of these. But for us, definitely, I think being an operating business is very key, and it softens the landing. That being said, if there is patience, definitely, we have worked on opportunities which we have spent close to 24 months with the entrepreneur, right? And we ended up doing the transaction. So I guess also for the entrepreneur, it depends on sort of how long, what is the waiting time? Is this a 6 months raise? We can't do that in 6 months, and we'll be very transparent and frank about it. But can we work together and get us somewhere? That is something that we have done quite often.
Yeah, I didn't mind adding to that from my experience, and I realised somebody else asked the questions about time frames earlier, which I left unanswered. And I think the time frame to raise institutional capital, let's call it, is maybe a bit like projections. There's an optimistic case and there's a realistic case. In the optimistic case, there's something like 6 to 9 months, and the realistic case is probably like 12 months, frankly, particularly for equity capital. And for institutional debt, it's probably 3 to 6. And I think your question related to kind of finding issues along the way, right? When an investor's nearly investing, I think I know your business has institutional investors already, right? Unless I'm mistaken. Okay, maybe I'm thinking of a competitor. In my experience of having closed quite a lot of deals in Africa. It's certainly not ideal when there are problems with the business that come up during the investment process, the DD process. I think, as George says, and to their credit, we've worked on deals with everybody here before, actually. And I think if they like the business and they trust the management team, it goes back to that point, really, that if the management team is investable and backable, they're probably prepared to do their best. There might be an impact on valuation. Yeah, which is not ideal, but perhaps fair. But also, I would make the point, I'm going to shamelessly plug advisors here as well. Actually, sorry, I apologize in advance for that. But I think the truth is, and we always advise people this, and often they don't take the advice, is one of the worst things you can do in an investment process is take your eye off the ball for the business. Right, and start looking too much more at how your investment process is going, and maybe looking at that prize of the 500 million at the end. Because what you really need to be doing is focusing on the business and continuing to be producing financial performance, operating performance in the business, and that's where I think advisors are particularly useful, because they can manage the whole process for you, and your job is to carry on running the business, basically. Yeah. Sorry about the plug, I hope you don't mind, but this was my honest opinion. Sergeant, were we going to try and close out the online questions and then close back to finish in the room and then everyone gets a drink?
Yeah, sure. I think I have about 3 or 4 questions. I think one is for the end, to leave it to all the panelists out there. Got a really interesting question, and this goes back to what George mentioned about planning for your exit. We've known private equities globally, especially in the West, that their main target is to be listed as a listed entity with an IPO. And interesting enough, Marie, this comes back to some startup unicorns. Just realizing India is launching 3 unicorns valued at $1 billion this week itself. So how are you looking at your exits, and what are your strategic options in this part of the world where listing is very difficult, or there's no market as such to list a particular business for your exit?
Who wants to go first on that? Very topical, challenging question for African investments.
Yeah, I mean, I can answer how we think about exit. The beauty of Antle is we come in so early that we don't need an IPO to return what we need to return to our investors. But at the same time, we need a liquidity event somehow, right? So I think we are actually doing some quite systemic work now, going through one by one portfolio company and sitting down with the founders and also understand what's success for them. Because also we need to work together as a team, I think, as number one. And second is, if someone is open to explore potentially, someone maybe could buy this business, I'm open for that. Then we can start to look at what could be realistic buyers of that company be, right? And of course, depending on the trajectory, you'll have different valuation expectations, of course, right? A struggling company is much, much different when you try to sell that versus a very high-performing company. So managing and working with a founder on that, I think, is something we're trying to do a little bit more systematically now. Also for us, the secondaries is a big opportunity. We're now seeing some rounds in Africa. Some rounds are too crowded, and it's almost like, I think investors here flock together too much sometimes. Like once a round starts to get hot, everybody's like in it. So, which in a way could be good if you're looking to exit that deal, because there may be more investors wanting to go in, and then you can sort of sell some of your shares and get a little bit of cash back in that way. So yeah, I think those are probably two things that we're looking at right now.
Okay, do you want to add, or should we move on to the next one?
Maybe just to add on the listings. I mean, we always try definitely to list our assets. I think the challenge with this market is definitely the market depth, right? You need somebody to underwrite an IPO. So what we've been trying to do definitely is to get the pension funds, more understanding on private equity, so that when we exit, they can also underwrite our exit. There's one we're working on right now, and hopefully, it will be a success, hopefully. But because we've tried it in the past and things did not go right well. But it's something to think about for all of us. And beyond us, definitely, is also the pension funds, the listed fund managers who are advising now the pensioners. I think they also need to be part of the conversation so that they can understand private equity, venture capital.
Yeah, so we've produced some statistics on this over the years, actually, and just to wrap it up, the most common exit routes are trade sales, actually, where investment is sold to a local or international industry player, basically. And then the second most common is a secondary buyout, where one fund will buy out the other fund. IPOs are very thin on the ground in Africa at the moment. We're all trying to change that, and it will change, I can tell you. I think the tide is starting to turn a little bit on IPOs coming. There are a number of fintechs in South Africa, for example, North Africa, Casablanca, we've seen a few exits via IPOs, so I think it'll come, but it's a different kind of exit as well. You've got to decide if you're an entrepreneur. We have a client going through this at the moment, right? That's quite a different life ahead of you, to be CEO of a public company as opposed to selling your business to another fund or to another trade player. So, but awesome choices to have in life. Next one from the online?
Yeah, sure.
How long have we got left, guys? Let's give everyone 5 minutes, okay? 5 minutes. Can you bear it? 5 more minutes. So please, we'll just wrap up the online questions, and then we'll take a couple more live, and then we'll all go and have a nice chat and a drink together after that. So Sajjan from the online.
Thanks, Ed. And I think this next question is really targeted to George and John. A lot of businesses here are family-owned, and people would like to understand the impact of this succession, and how have you tackled? George, I know you Africinvest invested in South Africa, and of course, John, you have BII that has invested in various other businesses outside some of the development side of things. So it would be good to understand what happens to a family business when you come in, and what is the impact that you face when you're coming in for a family to invest into a family-owned business.
For us, it's, the family will still be in control, truly. think my entire portfolio is family-owned businesses, right? Prime Bank, Seal Africa, Auto Express. These are still family-owned businesses in their own right. But they have transitioned these businesses, and we have helped them transition to independent management. That does not mean that the family is still not in the business, but there is, an independent CEO, for instance, with the family sort of being at the board level, the chairman level in the case of Prime Bank, for instance. So I think when we come in, I think we have a very good view of how family businesses function, and we've developed that track record in Africa, so we know what to do, we know how to speak. You can't just start rushing into decisions in family-owned businesses. You need to take your time, and that is why the relationship building is very important, so that by the time we are doing the deal together, we understand each other. We are more like friends now. So by the time we are coming into the boardroom, we know that we can get along. So I'll say that one of the reasons why family businesses come to us is because they really want us to help them with that transition from a pure family-owned business to an institutionalized business. But of course, the family will still be there. When we exit, they can exit with us, or they can remain behind and add more value with another investor. Yeah.
Good answer, thanks. So I think we've got like 3 minutes left. We'll maybe take one more online, then one more in the room, and then wrap it up there. Sajjan, have you got one more or not?
I've got one directed to you and one directed to all the panelists.
Okay. We'll try and answer quickly then.
Let's start with you.
I asked for a hard one, so now I'm going to get my punishment.
The reason for this, this is what we as investment bankers or advisors do, and the idea of storytelling and how important is that for a company that is trying to become investable or investor ready.
Okay, the question is storytelling, basically. Well, I guess I've spent time in the sort of mid-large cap world, and I've spent time now in the tech and earlier stage VC world. And I think in the tech VC world, earlier stage, the storytelling is really essential. I think the vision of the business, as well as, to be honest, the unit economics, and what did you call it? My favorite new expression at the beginning, your domain expertise.
Domain expertise.
Yeah, I think those are all key. But yeah, I always have like a natural objection to calling it storytelling, 'cause it sounds like you're kind of making it up. Yeah, but I think having that vision and being passionate and excited and knowing where you fit and how you can make it work is really essential for an earlier stage business. I think for a later stage family business, it's really more about the track record and the chemistry, I suppose, with the investor coming on. Yeah. What was the second one?
No, this is now for the three panelists.
Yeah.
And there are two questions, but I'm going to put them together. So the first one relates to the 5 points that investors usually consider. I believe that was on Kunal's presentation, and John, you touched on it again. What is more important for you and why? And then in terms of your fund itself, how patient are you as an investor and when it comes to growth and returns? And this is a question for everyone, because I know all three different types of investors on the tip.
Let's make it a wrap up then, and you can include your parting shot basically on what our kind of investable business looks like for your firm, maybe, and then wrap it up there.
Yeah, I guess I can start. I mean, back to the 5 team for sure is the most important, I think, for us at the stage we are. I also think that probably is going to echo in the later stages as well. Parting thought, you said.
On basically for your firm what an investable business looks like, so people can know who should.
Yeah, good question.
Approach you.
For us to invest in, probably anybody in this room, I think you need to leave what you're doing and come and build again. So if anyone is looking to build again, we love second-time entrepreneurs. We are in it for the long haul, literally a 10+ year journey, but starting from the very early days where anything is possible. So we spoke a bit about Greenfield. If anyone wants to do Greenfield, this is the place to come.
George?
The team definitely, and the sponsor. I mean that's critical because it's them that you're backing, right? And the track record. But for us, definitely, it's most likely an operating business. More often, a family-owned business that's going through a transition, but we are seeing at least even individual investors in our portfolio. That is sort of manufacturing, banking, like traditional sectors is what we focus on for equity transactions. Yes, yeah.
John?
Yeah, I think for me, aside from what has already been mentioned, is really to make sure that you get your fundamentals right, that you have your finances in order as early as possible. That means structures, finances, everything that goes around it, and that your business model has a lot of certainty around it. Investors like certainty, they like stability. Most investors, including ourselves, are less excited by a 10x return than they are by the stability of that return during the period of investment. I think that is something very important to note. My parting shot would be, for people in business and entrepreneurs, do not be afraid to explore all the options that work. Do not be afraid to pick the one that works for you, because not every single financier will work for yourselves. And also, more importantly, as soon as you're getting to the point where you feel like you're running around like a headless chicken, to get your pitch together or your funding pack together for a funder, speak to an advisor. Make your work easier. It's easier to also approach funders such as ourselves when you actually have somebody who knows what they're talking about.
Yeah, thanks. So I think that's probably a perfect place to finish, actually, and maybe summarize that's manufacturing Africa, really. Yeah, that for those of you online as well and here who have businesses that are not being supported by the program, but you feel like this kind of capital can be a fit for you, and some of those sort of milestones we talked about you're achieving, then please do reach out. I hope there's a way for the online attendees. I mean, they will have been invited by someone in the program, so please feel free to get in touch with us and talk more. And we're really, really keen to help lots of fantastic businesses like yours. So thanks a lot for bearing with us. This is a series of events, so please come to the next one. We'll put that out soon. And I believe that covers it for now. And please stick around. We'll all have a less formal chat. Deepa, did you want to add something? Oh, feedback forms. Yeah, bad luck. Please, could you fill in, please, because it's really helpful, actually. Just really quickly, if you could fill in the feedback forms, and then we'll leave it there. So I really want to thank my panelists, and I hope you'll give them a big round of applause, George, Marie, and John. Thanks, everybody.
Quick announcement. Yeah, what an incredibly insightful session, everyone. Learned so much. And thanks to the crowd for joining in online and those in person. And in terms of the slides, they will be circulated. It's going to be uploaded onto YouTube. And thanks again to the panelists for sharing your knowledge. And also thanks to the team that put this up together. And of course, thanks to you, the audience, for coming in and participating. Please do fill out the feedback forms, those of you online and in person. And we look forward to welcoming you for further episodes. Thanks so much. Cheers.